I'm standing in the way of cocktails. I don't know if that's better or worse than following lifesavers. Yes, I am a venture capitalist. That's a confession. I know that elicits a lot of different reactions from different people. So there's undoubtedly people in this room that have a positive reaction. You have friends that are venture capitalists. You started a business and partnered with a venture capitalist that helped you build that business, and that's all well and good. But I also know when I say venture capitalist, there are those that have this muscular twitch, and they see venture capitalists as those money-grubbing, company-flipping guys that are out to steal their firstborns. So both exist, but I know that the vast majority of people have this fleeting understanding. You may have gotten it from watching Wedding Crashers. The stars of that said they were venture capitalists in a feeble attempt to attract bridesmaids. Let me tell you, that's Hollywood. It doesn't work in real life. But if you don't understand, that's okay. My mother doesn't understand, and I've been doing this for 19 years now. So the fact that there are a variety of viewpoints on venture capital is not surprising. If you go back to the 90s and the internet boom, venture capitalists adorned magazine covers and were hailed as kings of the new economy. Fast forward to the last decade when things were a lot tougher, more likely we were characterized as opportunists trying to lay off ill-conceived business models on unsuspecting public investors. That's, of course, when we weren't laying curses on livestock. Speaking for all VCs, if I could be so bold, we're neither masters of the universe, nor are we diabolical hucksters. And so, if you haven't worked with a VC and a good VC, you may not know the role that venture capital plays in innovation, in business creation, and entrepreneurship. So I want to use the short time I have today to try and give you some new insights into that if I can. And I've got maybe an interesting, if not unique, perspective. I started my career with a big multinational company, GE. I spent a number of years there in a number of positions in their information systems division. I went on to run a couple of software businesses in a public environment. And then I even took a stab at running a company. That's how I ended up at NEA. On their doorstep, I was incubating that company with their promise to back me. One thing led to another. I became a venture capitalist. So I guess you can say I'm a failed entrepreneur. But nevertheless, I've got a perspective. And I think the first thing you have to understand is that we straddle two very different worlds. On the one hand, we get all the capital that we invest from typically large institutions. They may be state pension funds or corporations or foundations or college endowments. The hall we sit in, Northwestern, is an investor in NEA's fund. The other constituent group that we serve are entrepreneurs. They're the dreamers, the visionaries, the people who have the great business concept or technology that they want to grow into a fabulous business. They may have a financial motive as well, but typically, at least with the good ones, it's secondary to their real motivation, which is to create a great company. Even the way I'm dressed today reflects the two worlds that I straddle. My jeans say, "Hey man, I get your vision." My Italian sport jacket says, "Don't worry, I know what I'm talking about." So in serving these two different constituent groups, we also make two very different promises. So to those large financially motivated institutions, we're saying, give us a small slice of your big asset base, and we're going to give you outsized returns. Why outsized returns? Well, we have to, because we're inherently a much, much riskier financial instrument than anything else they invest in, whether it be equities, bonds, or real estate, whatever it may be. You know, the typical banker will categorize bonds as junk bonds if they have a perceived 6% default rate. Venture capital sees a 60% default rate as just the cost of doing business. Now, the promise we make to entrepreneurs is, besides giving them the capital they need to fuel their businesses, we're going to roll up our sleeves and help you build this business. So NEA's been around for 35 years now. We have some success under our belt. We have 170 odd IPOs, 290 acquisitions in our portfolio over time. And with that comes an institutional knowledge. We understand what it takes to build winning businesses. We understand best practices. We also have built, and we also understand where the landmines are. That together, that institutional knowledge together with the networks that we've built up, both personal and institutional networks, we leverage to help entrepreneurs in any number of ways, whether it's building management teams, helping them with their strategic plan, helping them find customers or strategic partners, whatever the case may be. But through it all, we're role players. The stars are the entrepreneurs. We're the Dennis Rodmans to the Michael Jordans, except we don't have the wedding dress and the orange hair and the nose ring. So the reason venture capital is critical in this world of innovation is, quite frankly, there's no real alternative that has both the risk appetite and the patience, with perhaps the exception of angel investing, but that in aggregate is at a much smaller scale. So I talked about the risk, but the patience is the fact that our typical holding period for an investment is 7 or 8 years. That's 30 times the typical holding period for a public equity. It's 2 times the holding period for long-term corporate debt. So not only is it a longer holding period and a higher risk, but also inherently higher volatility. So the short way of saying that is, this business is not for the faint of heart. But it's obvious why entrepreneurs look to venture capitalists for capital and why we're important in some sense to them. But why is venture capital important to everybody in this room? Well, there's some interesting statistics that have come out of research in the last several years. Some of it from Josh Lerner at Harvard, some of it from the National Venture Capital Association, and several other sources, but all of it points to the same conclusion. If you add up all the venture-backed companies and their contribution to the GDP, it's 21%. That's $3 trillion, 12 million jobs. So in a time when Washington's talking about job creation, you'd think venture capital would be more part of the dialogue. It's sad that it's not. That's another story. But the impact of venture capital in that absolute sense is huge. But it's really stunning when you consider the fact that it's really a small industry. Only 0.2% of the GDP is reflected in the assets under management in venture capital. So small dollars in, huge impact on the back end. It's been shown in studies that $1 of investment in venture capital in terms of R&D has 3 to 4 times the effectiveness measured by patents and other things than $1 invested in corporate R&D. So it's really huge, and the impact has been huge. And given that, I find it amusing that what many people see as the biggest weakness to venture capital, I see as its biggest strength. What I'm talking about is the lemmings to the sea stories. You've heard about it. You know, there's an area that gets hyped up. Venture capitalists pour in with a lot of capital. And eventually there's a train wreck, and everybody says, a lot of hype, a lot of waste. Well, you know, I look at that very differently. Admittedly, there's lots of losers in that process. But when you really step back and you look at what's happening here, it's an amazing story about the process of creative destruction, perhaps the best example of creative destruction that there is. So what you have at its basic level is communities of like interest seizing on innovative concepts, pouring lots of resources into it, often numbering billions of dollars, and doing this in a relatively short time frame, often in the face of brutal competition. So what you're seeing come out the back end of that oftentimes is transformational companies and sometimes whole new industries. So who can question that the infrastructure that got built in the 90s, that was venture-backed, that created what we all enjoy today as ubiquitous internet connectivity, doesn't touch each and every one of our lives? Not only did some great companies get created, like Amazon and Google, and they represent the 20% of the GDP that I'm talking about, but the companies that represent the other 80%, they couldn't really function in today's world without the technology that was developed out of venture-backed companies. I mean, at its very basic level, imagine a corporation operating today without email. So rather than lambasting the frenzy that accompanies this creative destruction process, we ought to be reveling in it. We ought to be cheering it on, because I'm convinced there's absolutely no model in the world that is more effective and efficient at value creation than that model. So the role of the VC in this process of creative destruction is to reduce the natural friction that exists between capital allocation and innovation. And it's this process of creative destruction and the sheer fun of building businesses that motivates VCs. Sure, just like the entrepreneur, they get attracted to the ability to build some net worth in the process, but that's not the principal motivator of most venture capitalists. If it were, all those VCs that built up some sizable net worths in the 90s, they wouldn't have toughed it out over the last decade. But when you look around, 95% of them are still doing what they were doing then, and the only explanation I have to that is they love building businesses, and that's what resonates with me. But when you wake up tomorrow, and I wake up tomorrow, when you put all this aside, we're facing a pretty tough world. The flow of capital reached a new low last quarter. The IPO window has all but shut down. But I remain optimistic nevertheless. Why is that? Well, one of the things we've learned, because we've been in business a long time as a firm, is this industry is naturally cyclical. And you really do have to invest in peaks and troughs, good times and bad times. The fact of the matter is a lot of NEA's biggest winners came from investments made in the toughest of times. You heard Tim's story of Pandora. That was made in a very tough time. So you simply can't predict when things are going to turn up. I got into this business in 1992. Things looked a lot bleaker then than they look today. Nobody did predict or could have predicted then that the industry was on the leading edge of what would become the most robust period in venture capital history. And so I'm optimistic because I think a lot of the ingredients are in place right now for an upcycle. You've got corporate R&D budgets that are getting squeezed. You've got academic research and government subsidies that are on the decline. But while all that's going on, and this is anecdotal, we're seeing at our firm the best example in both quality and quantity of innovation come through our doors than we've ever seen before. And with it, some superstar entrepreneurs, many of whom have done this, are doing it for the second, third, or fourth time. And so while all this is going on, we're in a world that's screaming, world economies are screaming for growth stories. And venture capital knows something about growth. So I'm optimistic that entrepreneurship and fundamental innovation is going to continue to thrive even in this environment. It's the entrepreneurs in this room that are going to make it happen, and the venture capital community is here to support you. Thanks.